And since we're recording, it's okay. I'm recording this, right, Drew?
Yeah, that's what
Yeah.
it says. Yep,
Yeah.
you're good.
Just making sure you're good with that. All right. So what you're trying to figure out is like, why would it make sense to utilize a life insurance contract to store capital and buying a car, right? That's
Right,
that's right.
right.
So the teaching that is really makes sense to a lot of people is that zero line, you know. Um, and so let's talk about that. You see that? Okay.
Yeah,
All right. This
yeah,
is the zero line, and most people either do two things with their money. They either save money, save money, save money, then they buy a car, right? Out of their savings account. Buy the car cash. The other people go into debt, right?
right,
Buy a car, go to Bank of America, go to Honda, whatever, the financing that they have, and they buy it. Okay.
right,
Whether you're saving money or you're borrowing money, you still have an opportunity cost of doing that one way or another. Does that make sense so far?
yep, yeah,
Okay. So let's look at the first way, right? And what happens is, and I used to joke with some of my clients is like, you never want to become a zero, right? You're not a zero, right? So
right,
why would you want to ever be at the zero line? And what does the zero line really mean? First option one, is you're saving money the Dave Ramsey methodology, right? You're going to save money, save money, save money in a savings account, and then you're going to deplete all the money and use it to buy the car, right?
yep,
Okay.
yep,
So let's look at that. This is the zero line right here. Okay. I'll even call it zero line. Option one. Option one. Save and buy. Let me step up a second. Buy cash. Make sense?
yep.
All
I
right.
know that one well.
Yeah, a lot of people do, right? And so what happens is this: you're at zero. You got no money in savings, and next thing you know, you're starting to save some money, right? So you saved a little, you saved a little, saved a little, saved a little. Okay. Now you got all this money in savings, right?
Yep,
Okay. And then you buy the car. And I'm just going to do it like that. I'm going to say buy. You buy the car. So right then and there, you bought the car cash. So now that money is gone. You will never see those dollars ever again. The only thing you could do is start saving again, right? So
right,
you save a little, save a little, save a little, save a little. You got the money 5 years later, let's say, right? And you buy the car cash. Now, what's cool there is you have the other car. It's not worth much anymore, but you probably traded it in and paid cash for the difference, and you bought the car cash again.
right,
And you rinse and repeat, rinse and repeat, rinse and repeat. So let's just say you do that a few more times. It's fair to say people usually do this, you know, every 5 years or so, even when they're buying cash. That's just reality. People do, you know, boom. So one, two, three, and let's just say 4 cycles, right? Of that. Boom, 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 boom. You buy the car. Okay. And now you're at zero again. And I'm going to put zero right here. So let's think through this. 5, 10, 15, 20 years later, you bought 5 cars and you're left with $0. You have the car cash that you bought, but you got nothing to show for it, right? Except the cars.
right, right.
Fair?
Yep,
All that money, this is one of the big premise of infinite banking, right? All that money was being saved in a savings account and flowing away from you to buy the stuff cash. Now, great, you didn't go into debt per se, but the opportunity to have that money ever work for you, it's gone. It just bought the cars,
right,
right?
yep,
The other way, option two, Can we see that? Yeah, we can.
Yeah.
Option two. Love my doctor's handwriting, don't we? Option two, finance. From, I'll just say bank. Right? Finance from the bank. Okay. That could be a car dealer. That could be their, Bank of America, whatever. You're financing the bank.
Okay.
And right then and there is what's going to happen is you're going to go into debt. So instead of saving money, right, you're going into debt. Same type of thing. So you start down here. Now you owe money, right?
Right.
And I'm just going to say owe. And same thing, but the reverse. You start paying it back, paying it back, pay it back, pay it back. Right? I'm going too much, but next thing you know, you paid off the car. Okay?
Yep. Yep.
And you got nothing to show for it, right? Zero. You go into debt again. Pay it back, pay it back, pay it back, pay it back, pay it back. Boom, zero. Buy your next car. Pay it back, making your payments, right? And we're doing it again. Boom, boom, boom. My handwriting's horrible, but you get it. Both ways, over time, you wound up at that zero line. So you had all this money flowing to the bank out of your checking or savings account towards the bank. What was that money doing for you besides paying the bank interest and buying a car?
Right.
Nothing, right? Okay.
Right.
So far so good?
Yeah.
Okay. Option three. Option three is forget the zero line. We don't want you ever winding up on the zero line. We want you having your money forever doing things for you and working for you. Okay?
Yeah.
And this may be the aha moment. Can you hear me if I'm turned away from you like this?
Yeah. Yeah. I hear you.
Okay. This may be the aha moment that most people need. Here, let me just create a new zero line. Okay. Aha moment here, hopefully. Right? I'm going to say option three. Option three. Become your bank. You know what that is, right? Become your own bank, right?
Yep.
Okay. So it's similar to saving in a savings account in your mind, in your mindset. Okay. Except you're saving it, storing those dollars inside of the life insurance contract that you have, the life insurance policy. Okay. So
Okay.
let's just do the same thing for a minute. You saved up. And yeah, let's do one more here. Boom. Right. And you saved up enough to buy the car. Does that make sense so far?
Yeah.
Okay. What happened with the savings account? You borrowed, right? And you had to start at zero, right?
Right. Yep.
Okay. But we're gonna just for simplicity, we're gonna make this make sense in your mind, hopefully. Like when you take a loan against the policy, not from the policy, against the policy, the in your mind, the value of what's available did go down. That is true. Okay. But when you pay it back, these are bigger, it makes a bigger difference, right? When you pay it back, it's actually up here. That's the new balance. Do you remember when it was all even over here?
Yeah.
Right?
Yep.
Because the value of the policy is continuing to compound and grow. Plus, you are paying it back just like you would a car loan. Okay. What's cool
Right.
is you You miss a month here or there, you have a bad year, like you don't have to pay it back.
Right.
If you're a good banker, right? Just like we've read it, we know it, we learned it, but just like Nelson Nash talks about being a good banker, if you're a good banker, like you're gonna treat it like you're both the client of the bank and the bank owner. So you both sides of the equation want a good banker, right?
Right.
Okay.
Yes.
So now your new balance is here. You notice how that's higher than here? Did
Yep.
did anything change in your mindset of saving money or paying back the loan to the bank? As far as the way you did it. You
Yeah, I mean, yeah. You're using the IBC policy, right? And it's
Yeah, you're
continuing to
using the
grow.
IBC policy, but as far as like the way it feels, you're
It
either
should feel the
saving
same.
you're either saving money in an insurance policy or saving money in a savings account or giving that $500 a month car payment to the bank.
Right.
Where you're flowing it makes all the difference in the world. Okay?
Yeah.
So now you borrow it again. Same amount, right? But but and I'm going to say right here is buy again, just like before. Buy. And now you're paying it back, paying it back, paying it back, paying it back. Boom. And the value went up. Do you see what's happening? Make sense?
Yeah, it does, for
And
sure.
now you buy another car. Boom. Pay it back, pay it back, pay it back, pay it back, pay it back. Boom. So is that four cars? One car, two cars. Yeah, that's four cars, right? One, two, three, four. Yeah. So at the end, you're not at zero, are you?
Right. No, you're not.
Where do you want to end up after 20 years? At zero and have a car cash that you bought? Or at, let's just pretend that says 50 grand. I don't know what that number would be, right? It depends on your cash flow and what's 50 grand. You want to be at
Right.
50 grand and still have a car that you own right outright or zero?
Right. Okay, that makes sense. That makes sense when you put it like that.
Yeah. That is the reason where you're really not changing anything as far as like your mindset of I'm paying back a loan, but where is the money flowing? If you save it in savings, now that money's gone forever once you use it.
Right.
If you use the bank, cool, you pay the bank and that money flew away from you. But if you're your own bank through that mutual, insurance company, now the money's constantly working for you and it's forever getting larger because you're banking out of it.
Okay.
One of my mentors said to me, um, you should always be in two businesses or careers. Like what you do for a living, and you may have heard this or remember from reading it in the book.
Yeah.
Um,
Yeah, I think I do.
and the other business you should always be in is banking,
Right.
right? The velocity of money is real. The flow of money is real. You just have to decide, like, you want the money working for you and flowing to you, or do you want the money flowing away from you, which the cash saver that uses that money and buys things cash, now that money's flowing away from them forever. The only thing you
Right.
could ever do is replace it to make more,
Okay.
you know? Um, when you borrow from a bank, that money again, all that interest is flowing away from you.
Right.
Does that help?